Hello, and welcome to season 3 of the Financial Secrets Revealed podcast. This time we are meeting the experts, and I am joined today by my lovely friend LJ Collier from Allan Gray. Welcome to the show, LJ.
Thanks, Amanda. Thanks for having me.
Not a problem. Now, LJ and I go back a few years. We first met in his beautiful hometown of Cape Town in South Africa, where you were still working for Allan Gray, and we did have a lovely lunch on the V&A waterfront and a tour of the building there. It's a beautiful spot.
Oh, absolutely. And as I recall, it was at a little place called Savruga. We had a beautiful bottle of white wine, and I think you had the fish of the day, if I can
I
recall.
definitely had seafood. It was
Yeah.
spectacular.
And I see it's there still today. I mean, but that must be what, a little bit more than 10 years ago, Amanda?
Well, it was
Or am I
before
getting them
you
wrong?
had come to Australia,
Yeah.
so
So
yeah,
I've
I
been there
think at
for 8 years
least
now.
8 to 10, yeah, for sure. So, are you enjoying being an Aussie now?
Oh, absolutely. I've got two little Aussie girls, so I mean, yeah,
Fantastic.
it's a fantastic place to live, isn't it?
Oh, couldn't agree more. Couldn't agree more.
Yeah.
So you work for this company, Allan Gray, who are known globally as contrarian investors. Now, my dad used to say I was a contrary little thing. So I'm just wondering, what is contrarian investing all about?
Yeah, absolutely. So, contrarian investing, I guess if you kind of like just go back a little bit and you say, okay, well, how can I, as an investor, or how can I find managers that can actually beat the market? And you think about it that way, then you say, well, there's a few different ways of doing it. You can either be a momentum investor and go with a pack and run with those type of things, or you can do just plain index investing, get market returns, and not look to beat it, which is a very popular way today. You could just look
Absolutely.
at the likes of a lot of index investing is just
Yep.
taken off,
Low
hasn't
cost,
it?
not a lot of
Absolutely,
work to do.
yes.
Yeah, for sure.
But if you're looking at hiring a manager to deliver you an outcome better than that of the market, you've got to ask them, that manager, you've got to ask them and say, well, what do you guys do sustainably to actually deliver me a better result than that of the market? And so, and thinking about when somebody how the market works, there's a buyer and there's a seller. So if you're going to buy a stock, somebody's selling you that stock, and the market's not a real nice place. And inverted commas, nice place. People don't just sell you stuff for less than it's worth because they're nice. It is a faceless environment, and you've got to think, well, why is that person actually selling me the share? And the way that we look at the world is we say, well, the best way to look at to try and buy things for less than they're worth is when people are making behavioral mistakes. And those behavioral mistakes don't happen when things are just going glorious and happy days and everything like that. Generally, these behavioral mistakes happen when things are uncomfortable. And so being a contrarian is when somebody actually says, just sell that share. I don't want to look at it. I don't want to explain to my client why I'm owning that share. At that point in time, it probably makes a lot of sense to start looking at that share, because that's an irrational thought pattern. And so that's what we do, is we look for those places that's uncomfortable. People don't like owning those shares at that point in time. And then if you can look through the cycle and you say, well, I can pick this thing up with a share up for a lot less than it's really worth. Through the cycle, hopefully it goes to what it's worth, and then you've made more money than what you would have just got by investing straight up in the market. Now, it's not easy to do.
So
Uh,
this is basically you're buying when everybody's selling and you're going to sell when everybody's buying. So you're going completely against the herd, I'm guessing.
yeah,
So
correct.
that's got to be, yeah,
Yeah, and as humans, we're not wired to do it that way, right? I mean, we have actually evolved to run away from the lion. That one contrarian that actually stood there and say, "Oh, maybe I should look at this lion and maybe touch it." That
it's a
one
very
didn't
little African touch there, LJ.
exactly. Well, we could call it saltwater crocodiles, right? So, but,
Go the
but
salties.
yeah, but we as humans, we haven't evolved being contrarians. We've evolved being herd animals.
Yeah, fitting
And
in,
so
absolutely.
it's really hard to do to actually be on your own, on the outside. But it's just, if you think about it just from a from how to make money perspective. I mean, you can ask most of your clients, if they're business people, how do they make money? They say, well, I buy something for cheap and I sell it for more expensive, right? And so that's how you make money. And a lot of times when people look at investing in the stock market, they look at it from a different angle. They say, oh, I just want to start investing when things are certain. And yeah,
I'd
we've
just
given
like to get
that.
in at the start of the next bull run, if you don't mind. Can we just sell at the top? And yeah,
And,
absolutely.
and we've seen it so many times. You buy expensive and you sell when things are uncertain, and then you repeat that until broke, right? So we try and do the opposite. We try and buy things when they're cheap, when they're unloved, when people find it a little uncomfortable to have a look at that spot. So
So
yeah,
when I'm telling people bottom pickers get smelly fingers, then you're doing the opposite. So you're playing the fear versus greed game,
absolutely,
but in an intelligent way. So
yeah,
if you're doing that when everyone else is frightened and you're going, right, this is a brilliant opportunity, how are you picking the stocks
yeah.
that you want to go, all right, actually, we think this one's undervalued, even if it's unloved?
I like that, picking bottom gets my fingers.
Smelly
Good
fingers.
analogy. I love that. I think the big thing is, and Dr. Simon Morea used to say that there's only one trade at the bottom and one trade at the top, and so you will never be able to pick the bottoms and pick the tops out of this whole situation. And so if you break up the market into thirds, or the price of something into thirds, and if you have any sort of sense of financial being, you would know that, does the market feel expensive? Does it feel kind of in the middle of the range, or does it feel cheap? And so you buy it when it's in the cheap third, and you sell it when it's in the expensive third, and you should do okay. Uh, the people that buy the bottom all the time, those are Bernie Madoff, right? And we know how
The
that,
Ponzi schemes, yeah, that works
yeah,
beautifully for all his
yeah.
investors.
So we're very conscious of the fact that we don't get everything right. Good fund managers pick 60% of stocks that beat the market, and 40% don't. Um, and that's a horrible stat, because imagine going to the doctor and the doctor tells you, "Hey,
I've got a 60% chance of getting this right with you. I
my
reckon you've got diabetes, but I'm not quite sure.
well, 60% of my patients survive. It's you go back. You know, um, uh, but funds management is a zero sum game. You either uh, make money for your clients, or you don't. It's not a that's just how it works. That's the reality of the
It's
market.
an interesting concept you said about the putting it into thirds, because I mean most people, when you're picking the bottom or picking the top, you don't want to, I suppose, leave money on the table at either
Mm.
end. You've got to be prepared to go, you know what, it's done really well. We've made some money. It could go up another 10%. We're happy with what we've made. Or, you know what, we're going to sell it here. It might go down further, but we're happy with this price. So
Yeah.
it's, I think, setting those limits, is it, that you're talking about, that you make those decisions in those bands?
Absolutely. I mean, just okay. This is very self-indulgent, but the way that we view the world is that there's three parts of our strategy. The one is contrarian. We find our ideas from those places that people uh, don't like to go at this point in time. And then the second is fundamental. So we've got to do the work and find out what this company is really worth. And companies are only worth all their future earning streams back to today. And so, if we can pick up those future earning streams for less than it's trading what it's really worth, then we'll buy those companies. And the fundamental work is really really important in this situation. You can't just dream up a number. You have to know what it's worth. And I think you're right there. When once it reaches that estimate of value, you should sell it and look for new ideas.
So one of the most famous people who does this, I believe, is Mr. Warren Buffett of Berkshire Hathaway, and he's done it very, very successfully for
Yeah.
a very long time. How do we, I suppose, take advantage of contrarian investing? If we say, look, I'm a bit of an index investor, you know, even Buffett said I can't beat
Yeah.
the index over the long term. Should I just stick with that? How much of my portfolio would I then be worth looking at? You know what, that contrarian approach really does it for me. I'd like to
Yeah.
put some of my money in that. What sort of a percentage do you advise clients to do? Is it the look, go gung ho, if you totally believe in it, you're committed, just do it, or dabble?
Yeah, so that's a really difficult question to answer because then you venture into personal financial advice. We've
True that.
actually just done the trading around that. But the way that I think about it is, if you there's no one style of investment that would work 100% of the time. And so the most important thing of investing or investment strategy is to actually stay the course. And so chopping and changing between things rarely gives you a really good outcome. And so understanding the fund manager or the philosophy that you use in a portion or a bucket of your investment is really important. And then stay the course, because if you go back 120 years, value investing has really worked and it's done well. But if you look at the last 10, 13 years, it's done pretty poorly. Now, does that mean value investing is dead forever? Probably not. I think there are a few setups that made it really good for growth and momentum style investors. But is value dead forever? Geez, you don't. So how do you actually break those components up? I would recommend and advise to go and see a really good financial planner as yourself. Um, but I do think that you cannot just ignore a contrarian manager and say, well, those guys are risky, because I believe we're probably less risky than the market. If you look at our volatility statistics, compare that to the market. I know this is very big financial jargon that you can get into, and deep words you can talk about, but our volatility around the market is way more around the upside. When we outperform the market, we look more volatile than that of the market. Not necessarily. We're not necessarily more risky than the market in total.
So there's got to be times when contrarian must work really, really well,
Mhm.
and other times when the wheels fall off completely. And I mean, you've just done that, value versus growth investing.
Yeah.
When does contrarian work well, and when is it just going to be a dog? Are there
Yeah.
times?
So yeah, I mean, and I wish I could pick those times exactly. Otherwise, I would have sat on a
With
yacht
the benefit of
somewhere.
hindsight,
Yes, yes, with the benefit of
looking
hindsight.
back,
Exactly. So contrarian investing does really well when value investing does well. So you can find that during growth periods of time, when growth beats value, contrarian investing does well to keep up with the market. But it really comes into the fore when value does well, and so you can add a lot of mind the pun value during a value period of time. Uh, and can you pick the top and the bottom of when that happens? Unfortunately, not. Uh,
crystal ball's broken.
it's a little dusty. Yeah, yeah,
Quite murky.
yeah,
You've mentioned the analogy in the past, I remember, of the tortoise and the hare. So, can you
yeah,
elaborate a little bit more about how that comes into play with
yeah.
contrarian investing?
Well, a lot of the times, and specifically, sometimes it makes sense to be the tortoise, and sometimes it makes sense to be the hare, and really run things quickly by. But at this point in time, I mean, investing shouldn't be the next sexiest thing out there. It should be pretty boring, and if you miss the big holes in the road, you should do okay. If you look at where we've invested our portfolio right now, it must be in some of the most unsexy stocks out there. It's just so boring. Uh, but that feels comfortable at this point in time for us, just because of the valuation. So price matters, right? So if you pay too much for something, you're never going to get it back. Um, so just look at what you're paying for those things, and holding on for a period of time. Our average holding of a stock is since our inception is about 4.5 years, 4.25 years. So it's a little bit longer than the average market participant out there. That I think the ASX stats say it's about a year, somewhere around there. So yeah.
And mostly, I mean, financial advisors in general, when they're talking to people about investing in shares, we're talking about a 5 to 7 to 10 year holding time
Yeah.
anyway, especially if we're looking at like an index style of investing. So, those longer terms with shares, 4.5, five beyond, should be very standard speak when we come to shares, unless you're a day trader and stock picking.
Yeah.
There is that holding time. So, can I just back up a little bit? We've talked a little about value and growth investing. For those who don't know much about that, can you just give us a little bit of an overview on what both of those styles are and how they work?
Yeah. Okay. So these are, I would call them the academic kind of really. Um, uh, I, I mean, there's very few managers that say this is how I think about the world. But when you look at how the investment style actually comes up, uh, they end up in these two predominant buckets. And the one is, well, you said value, and that's kind of like where we would call ourselves probably closer to value than growth. And so value typically is low price to book, low price to earnings ratios, those type of companies, and they trade at those levels typically because something has made them trade that way. So they could have they might be an incredibly boring company that has fallen out of favor a little bit, and so then they trade at these low prices. And then growth style companies are those that are trading on massive future expectations. So they might trade at high PE ratios, and then what that means is that you have to have a lot of future earnings to make up for the price that you're paying today. And some of those companies have done exceptionally well over the last 10 years. I mean, if you look at where interest rates were just a few years ago at zero, you can actually carry those companies for quite a while for the big future payoff, because it doesn't cost you any money to carry those companies in your portfolio.
So, how much do I suppose global economic or political factors play in? Like if there's elections coming up in the
Yeah,
States, or there's,
yeah,
a new prime minister in England, just for a change, how
yeah.
do those sort of things, not that Australia is too much better, how did they play into the value versus growth investing talk?
That's super interesting. I mean, if you look at so we look at the economists forecasting and things like that, and we say, well, we can't do that really well. We're not economists. We don't employ any economists, and we never have at Allen Gray or at Orbis, our sister company that's based all over the globe. We've never employed economists because we don't believe that that's where we have the edge. Where we have the edge is looking at the companies and what should they earn sustainably through the cycle. And what do I mean by that is, if you look at the whole, let's call it energy sector, what are those companies producing on average a barrel of oil at, or a uh, uh, and so that means that we can then assess the companies that we're looking at. Are they trading at, well, are they delivering oil at more than that or less than that? And then where on the cost curve do they sit? And so if you look at the whole industry and you say, well, the oil price today, there's a lot of companies that don't make money. That means they're probably going to go out of business, which means the oil price could go up from here. And so that's more a way of looking at it from a probabilistic point of view than actually having a look at it and saying, well, I believe oil price is going to do this or that, or the political stand. The new prime minister has a this view on energy, and so they're going to implement that. because it's very hard to predict those type of things.
Indeed. So one of the other things I know you've said is avoiding group think.
Yes.
So it's probably plays back into that fear and greed conversation. So do you just not listen to all the talk, or do you listen to it, take it into account, and then discount it based on
Yeah.
what you do? How does it, I mean, you must, obviously you hear what's going on. You're
Yeah.
involved in it all the time. How do you then avoid it when you're hearing the noise?
Yeah, absolutely. I mean, for us, it's doing the work first and foremost on the numbers and figuring out what this company is worth before we go out and say, well, how loved is this company in the market out there? And how we do that is just looking at broker reports. We don't use them for our fundamental analysis or anything like that. We just look at, well, how many buy ratings are there on this company and how many sell ratings are there? And if there's more sells than buys, then it's probably a good spot to start looking at. You can almost stand at a barbecue and hear how many people hate the stock, and that could give you a good way to start looking at good prices. Because if the tip is already at the barbecue, oh, this is a great stock, then everybody probably knows that already, right? And so, how do you avoid groupthink in that sort of sense? The way that we do it is we employ people from hard science backgrounds. So they don't have any, and typically they don't have any investment experience before they come to us. And the reason behind that is, well, we like the way that they can build a cold hard thesis on facts and not fiction or feelings or emotion. And so then we tell them, go and find the best companies that you can. And then we argue with them, is this a good idea or not a good idea? Um,
Your board meetings sound interesting, or your investment committee meetings.
they are quite brutal because it's thesis defense situations really. So you have to have a pretty thick skin and not worry about what people think about you. You should worry more about what do they think about the facts that you represent. And yeah, I mean we do have some turnover in the younger analysts because not everybody really likes that. Um, but those that stick around, and our investment team has been pretty solid for quite a number of years now, and they've stuck around for quite a long time. They feel comfortable being in an uncomfortable situation. I would describe them like I don't know if you remember The Big Short. The Michael
Yes,
Berry character. I
yes.
would describe them those type of guys. That comfortable being this uncomfortable situation
Yeah,
of
so we could go African again. You say you got to have a hide like a rhino. There we go. We'll dump in
yeah,
the big five while we're at
yeah,
it.
yeah, exactly. Yeah, yeah.
So
So
that's really interesting. That must be a lot of fun, actually, if you sort of take the personality or the personal factors out of it and just
yeah,
yeah.
if you have a look at, I mean, if you have a look at the investment philosophy and why contrarian works and things like that, it just sounds so simple, right? It sounds like, well, we buy cheap stuff that are unloved and then we sell them when they get more loved. Uh, but it's a hard thing to do because you're the only buyer on the one side. People are saying, geez, you must be crazy owning that thing. Why are you so mad? And then the only thing that you can really fall back on is the facts and the numbers and the future earnings of this company. That's the only thing that you can fall back on is your work that you've done. And so if you can't do that, then you can capitulate, and that could be the worst time to do that.
So if people want to find out more about contrarian investing, are there good places to go? Do you have good resources on the
Yeah.
Alan Gray website? Is it just put it into Dr. Google? What's the best way to find out the real stuff?
Absolutely, yeah. Our team has done a great job to do. There's a guide to contrarian investing on our website, and then there's a few books that you can have a go at and read that I think is uh, for any investment professional. It's great books to actually have in your back pocket. And Howard Marks writes some great papers around that as well. And I would recommend his book, The Most Important Thing.
The Most Important Thing by Howard Marks. Okay.
Yeah, yeah, yeah. It talks about second level thinking, things like that. Really, really great book, and easy, understandable, but it gives you a good feeling of how the market works and where you can actually add value. If you can't add value, just buy the market, like Warren Buffett
Yeah.
says. Yeah.
So, how long has Alan Gray been around and doing this style of investing?
Yeah. So this is our 50th year. Alan started the business in 1973.
That was a very good year, personally,
Yeah.
without
Can't,
giving
can't,
anything away.
yeah, nothing. So we've been around since 1973, but only in Australia since 2005. Our global company Orbis, Alan started the global company called Orbis in 1989. And the interesting thing about this investment style or philosophy is that wherever we've deployed it, be it the Japanese fund, the emerging markets fund, the global fund, the South African fund, the Australian funds, we've been able to add value over time for our clients. So it does go to show that human emotion is not something that just goes away or is geographically it needs to be in one place or so. It's all over the globe. Uh, but if you believe that we're going to wake up tomorrow completely rational, we're not going to have any emotions, computers are going to take over, then I would question why you would look at a fund manager in total, and then probably the market would probably be the best place to invest an index fund. Yeah.
With the style that you do, I mean, there's more people having an awareness and wanting socially responsible governance fund like ESG.
Yes.
Can your style play a I can't even speak, play a part in the ESG style of investing? Is it compatible with that?
Yeah. So if you have a look at, well, as I mentioned just a little earlier, that the future earning streams of these businesses today is how you value a company. That means that you need to make sure that these companies can sustainably earn those earnings going forward. And so, from an ESG perspective, I mean, G governance, I mean, Australia is pretty well regulated, so I don't think there should be too much of an issue there. Although we do have a sustainability analyst looking at these things for us over the top of the research that we do. The social impacts, yeah, there's definitely uh, a pretty grey line as to draw what gives you social impacts. Casinos, should you not invest in those type of things? And then on the environmental side, you've got to look at things on the counterfactual point as well, right? So we're not talking about being net zero in 2024, 2025. We're talking about being net zero in 2050. Um, and so those are things that you need to consider in your investment theses when you invest in these companies. So ESG has always played a part in our consideration as to what is a company worth. Is it worth? But again, the counterfactual bit around if Illumina doesn't exist, where does that demand get um, satisfied?
So you don't have a particular contrarian ESG stock, but it's an overlay when you are looking at stock picking within the company.
Absolutely. I mean, sustainability is a major thing around how to value a company, and that needs to play a factor in everything that we do.
So the other question, I guess, is if you're looking all the time at all these different investments, if your cash balance for the fund manager is quite low at a time because you're heavily invested, how can you take advantages of others? Do you have to wait for a stock to go up and go, all right, well, we'll sell that one now just to take advantage of this one? How do you play that game?
Yes. So that's a really interesting question. I mean, for our Australian, so we have three funds: a Australian equity fund, a balanced fund, and a stable fund. And all the assets in all three of those funds uh, are competing with each other as to relative attractiveness, really. And so for the Australian equity fund, it might be that, hey, there's a really good new idea that's come up. Is this relatively more attractive than the smaller stock that we own? And so then we have to sell out that smaller stock to actually buy this more attractive opportunity going forward. Yes. So we always, for the equity fund, we always have to be 100% invested. Our clients come to us and they say, here's the mandate, just go and buy the best stocks for the next 5 to 7 years that you can. Within the balanced and the stable fund, well, we have to look at all the other securities, be that cash, be that bonds, be that whatever the case may be, gold. Do we want to own this security, or do we want to own the equity that's come up? So it's always a relative game for us in terms of what is relatively most attractive. In the Australian equity fund, we don't have to own the market. We only own 47, 48 stocks today. But what that means is, well, it is quite concentrated. The top 25 stocks make up about 89% of the portfolio. So what that means is, by definition, if one stock does really well, we'll probably start selling that and then start looking for new ideas.
Cool. So it's constant to play them off against what's the next thing, I guess, to be able to make those contrarian investments and decisions.
Yeah, absolutely. And the other important thing is, I mean, some people ask us, okay, if you had to start with a blank sheet of paper, what would you own? I think the stocks that we own today would be the ones that we would own from a blank sheet of paper. We don't start with an index and say, well, this is the index. We have to up and down weight these things. We start with a blank sheet of paper and we say, are these things really attractive? Do we want to own them? And then we would, yeah.
Yeah, interesting. Thank you so much, LJ, for doing the deep dive into contrarian. For those people who've got their head around it a bit now, I'll make sure in the show notes we put the links to the paper and that book.
Absolutely.
Is there anything else as a parting thought on contrarian you'd like to share with us?
I don't think the concept is hard. I think it's difficult to do. But I do think that there is a lot of value to be added if you can do this consistently going forward. So I'm excited at the prospects of where our portfolio is today compared to that of the market. But who knows if the market's going to go up or down? I mean, like you said, the crystal ball's a little rusty,
a bit murky,
a little bit murky.
Busted ass, yeah.
But yeah. That's probably where I would.
I suppose, just like you said, the understanding of how it works before you make any decisions about, this is the thing for me. No, perfect. Great way to
specifically, any investment philosophy, any stock, anything you invest in. I see a lot of people spending a hell of a lot of time on researching the houses that they want to buy, in what street, in what suburb. How does the roof look? All those.
What's the closest school? Where's the shopping centre? Yeah,
yeah. But sometimes just with shares, it's just too easy. Do your work. Look at what it should be worth. I think that's probably the parting.
Or outsource it to someone who does that.
You could, yes, yeah.
Perfect. No, thank you so much for your time, LJ. Really appreciate it.
Thanks, Amanda.